Today, we're diving into an investing philosophy that kind of flips everything on its head. It's one that says you can actually achieve more by doing less. Yep, you heard that right. It's called the Boglehead way, and it's influenced millions of people by boiling down successful investing to just a few common-sense ideas that totally challenge the financial industry.
So let's kick things off with this quote from Warren Buffett. Returns decrease as motion increases. Now that sounds completely backward, doesn't it? But this one simple idea gets right to the heart of the problem that the Boglehead philosophy was created to solve: the massive and often totally hidden cost of being super active in the market.
So what is this problem exactly? Well, Vanguard's founder, the late John Bogle, saw it as a huge, fundamental flaw in the system. He literally called it a loser's game. He argued that the entire structure of the investment world is basically set up to make it incredibly hard for the average person, like you or me, to actually win.
And here's Bogle himself laying out the core idea. Successful investing, he said, isn't about some secret formula or being a math genius. Nope, it's just common sense. It's simple. But, as he points out, it's not always easy. Why? Because it takes discipline in a world that is constantly screaming at you to do the exact opposite.
The math behind this whole loser's game thing is just brutally simple. Okay, picture all investors in the world. Before you factor in any costs, trying to beat the market is what's called a zero-sum game. For every winner, there has to be a loser. But here's the kicker. The second you subtract the costs, and there are always costs, like manager fees, trading commissions, taxes, the whole thing becomes a negative-sum game. As a group, investors are mathematically guaranteed to earn less than the market itself.
And Bogle had this brilliant little story to illustrate the point. It's about a fictional family, the Gotrocks. At first, they own all the businesses in the country, and they get to keep all the profits. Simple enough. But then, they start hiring helpers. First, it's brokers to help them trade. Then it's active managers to help them pick stocks. And then, it's even consultants to help them pick the managers. And with every single layer of help, a slice of the family's pie gets taken away. Their share of their own wealth just gets smaller and smaller and smaller.
So what's the real-world price tag for all these helpers? Honestly, it's staggering. Look at this number. $323,600. Let's say you started with just $10,000, and over 50 years, the market grew it to $469,000. Well, if you were in the average actively managed fund with all its costs, you'd be left with just $145,400. The majority of your potential return is just gone, vanished, eaten up by costs. Okay, so if trying to find the best stocks and beat the market is a loser's game, what's the answer? This is where Bogle's truly revolutionary idea comes in. He basically said, stop playing their game altogether. Instead of trying to find the needle in the haystack, just buy the whole haystack.
And when you put the two approaches side by side, the difference is just stark. Active management has one goal: beat the market. It's really expensive, and the data shows that something like 85 to 90% of them fail to do that over the long haul. Passive indexing, it has a much humbler goal: just match the market's return at an incredibly low cost. And the result? You're pretty much guaranteed to get your fair share of whatever the market gives.
And the tool that makes this all possible is the index fund. It's a beautifully simple invention. It's a fund that doesn't have a manager trying to be a hero and pick winning stocks. It just buys all the stocks in a market index, like the S&P 500, and holds them. That's it. This gives you instant diversification, ridiculously low costs, and almost no trading.
And this is Bogle's most famous line, the one that perfectly captures the whole idea. Why on earth would you spend all your time, energy, and, most importantly, your money trying to find that one magical stock, the needle, when you can just own all of them, the entire haystack, for a tiny fraction of the cost and be almost certain of a better result? It's just common sense.
But this whole thing quickly grew into something much bigger than just buying index funds. It became a complete mindset, a really disciplined approach to building wealth, and it's championed by this amazing community of followers who proudly call themselves Bogleheads. And if you look at their core tenets, you see it's way more about your behavior than about your specific portfolio. It's about building a solid foundation, living below your means, investing on a regular schedule, and just keeping everything as simple as possible. But maybe the hardest and most important rule of all? Tune out all the noise and just stick to your plan, no matter what the market is doing.
And the really cool thing is you don't have to do it alone. A massive, super supportive online community grew up around these ideas, where regular investors help each other figure things out and stay the course. And it's all for free.
It's all about sharing wisdom, not paying for some expert secret advice.
Okay, so this all sounds incredibly smart and sensible, but is it perfect? Is it the only way? Let's add a little nuance here. Because no philosophy is perfect, and I think it's always valuable to hear a friendly reality check. This one coming from another huge admirer of Bogle's work, Dr. Jim Dolly, who you might know as the white coat investor.
So one of the main critiques is that sometimes Bogleheads can miss the forest for the trees. The community is fantastic at optimizing a portfolio down to the last basis point. But, as he says here, for someone with a $1,200 portfolio, arguing about tiny differences in fund fees isn't the key to wealth. The real key is figuring out how to increase their income and save more money.
Dr. Dale also points out the risk of things becoming a little too dogmatic. The three-fund portfolio is a famous Boglehead model. It's super simple and it works. But sometimes a very vocal minority can make it sound like it's the only right way, which can lead to a kind of groupthink that shuts down other perfectly good strategies.
And finally, what about other ways of building wealth? Sometimes the philosophy can feel a bit narrow, kind of dismissing entire asset classes like real estate. The argument here is that a wise investor knows there are many paths up the mountain. You don't have to limit your toolbox to just stocks and bonds. So, after looking at the core philosophy and some really valid critiques, what's the bottom line? What are the big takeaways from the Boglehead philosophy that pretty much every investor should think about? It really boils down to 4 timeless principles. 1. Costs matter. A lot. Every dollar you pay in fees is a dollar that can't grow for you. 2. Diversification is your best friend and your greatest defense against risk. 3, and this might be the most important, your own behavior is way more important than finding the perfect fund. And finally, in a world that sells complexity, simplicity is your superpower.
And this last quote from Bogle just nails it. So many investors get derailed because they're constantly chasing something better, abandoning a perfectly good plan because they're dreaming of a perfect one that probably doesn't exist. The real key to success is finding a good plan and just sticking with it.
So we'll just leave you with this question to think about for your own financial life. What's actually more valuable? A so-called perfect plan that you ditch in a year? Or a good enough plan that you can actually follow for the rest of your life? The answer to that question, well, that's the heart of the Boglehead philosophy. Thanks for joining us.